When you think of a financial bubble, you usually think of Wall Street, tech stocks, or crypto, but today let's take a completely different look at one of the most famous bubbles in financial history. You think you already know the story: tulip bulbs, crazed merchants, panic in Amsterdam, and prices that exploded overnight. But what if I told you this story wasn't just a madness about flowers, but that behind it lay the financial architecture built by the world's first multinational corporation, the VOC? What we call the tulip bubble today is often told as a simple moral tale: greedy people, unnecessary luxury, and the collapse they deserved. But this narrative hides a very critical detail. In the same period, the world's first major stock exchange had been established in Amsterdam. VOC shares, forward contracts, and speculation techniques formed the prototypes of modern finance. And this system didn't just include spices or silk. It also turned tulip bulbs into part of a global game. In this video, we will go beyond the known tulip crisis. Instead of only explaining why tulip prices rose and fell, we will ask the real question: who built the financial foundation that made this crisis possible, and how? And we will see that this question leads us to the hidden influence of the VOC, a corporate power capable of steering prices and expectations from afar. At the beginning of the century, the Dutch Republic was the richest and most innovative economy in Europe. Amsterdam was not only a trading port, but also the world's capital center: spices from Asia, porcelain from China, textiles from India, slaves from Africa. At the center of this entire flow stood the Verenigde Oostindische Compagnie, the VOC. Its shares could be freely bought and sold on the Amsterdam Stock Exchange, and for the first time, investors could become part of a long-term company. This new financial world created an environment where even an ordinary merchant could not only sell goods, but also bet on prices. Interest rates fell, liquidity increased, and room for speculation expanded. People were no longer just selling coffee or cotton. They were buying and selling papers about future prices. So when the tulip crisis began, the Dutch had already learned the techniques of the game called speculation, forward contracts, the feeling of leverage, and crowd psychology driven by rumors. Tulips were not a direct product of the VOC, but they became a side game played on the financial stage the VOC had built. Rarely colored tulips in particular attracted the interest of aristocrats and wealthy merchants as status symbols. While everyone was chasing a unique bulb they had never seen before, the wealth explosion created by the VOC conveniently provided the pockets to finance this demand. So how did this bubble form technically? The period when tulip bulbs could physically be bought and sold was very limited. Bulbs were underground during certain times of the year. Despite this, in the winter of 1636 to 1637, it wasn't real bulbs changing hands, but paper rights to bulbs that would be delivered in the future. In other words, people were effectively buying and selling a kind of forward contract, the right to buy a certain tulip at a certain price in the spring. This was primitive but effective financial engineering. In the same period, similar forward-dated transactions were being made with VOC shares, and investors were borrowing to take positions. The legal status of tulip contracts was unclear. When one party lost the ability to pay, the entire chain shook. In a sense, the idea of getting rich on paper, normalized by the success of the VOC, became an out-of-control version of itself. In the tulip market, prices rose slowly at first, then insanely. A single bulb selling for several times a craftsman's annual income, rare varieties changing hands for the price of a small house. In a meeting room, a mere sheet of paper being passed around for a bulb still underground. This was a very early rehearsal of the derivative products madness we see in modern financial markets. Here, the VOC's role was not directly buying and selling tulips, but the financial culture, risk appetite, and speculation mentality created by the company seeped directly into the tulip market. The same investors who had gained or lost fortunes on VOC shares carried their credit and trust relationships into tulip contracts as well. Bankers, brokers, notaries, all were part of the same ecosystem. Tulips were simply the new toy in this network. So what was the breaking point? At the beginning of 1637, a small auction failure and a few buyers saying, "I won't buy at this price," broke the psychological threshold. Within a few days, the belief that it will surely rise more was replaced by the fear of, what if I can't sell? When a few weak links in the chain went bankrupt, many forward contracts were left on paper only. Taking these legally unsettled contracts to court didn't help. The state chose a middle path that effectively abandoned protecting creditors in order to avoid a wave of bankruptcies and social chaos. What is interesting is this. Contrary to the popular narrative that loves to pretend the Dutch economy completely collapsed, the country's macro-level wealth largely remained intact. VOC ships were still bringing goods from the Far East, and the port of Amsterdam was still overflowing. So the tulip crisis was less a system-destroying catastrophe and more of an experiment in which the financial elite mismanaged risk transfer among themselves. Those who paid the biggest price were the most leveraged, and those who had piled the most paper. Still, this small rupture produced two important outcomes for future financial financial crises. First, the idea that forward contracts and option-like structures must be regulated more carefully gained strength. The papers written for tulip bulbs eventually inspired more sophisticated derivatives. Second, financial circles that included the VOC realized that even if they did not directly manipulate prices, the asymmetry in who held information and who exited the market first would always leave the ordinary investor at a disadvantage. Looking from today, there is a chilling aspect to this story. The games played with tulip bulbs and VOC shares back then are repeated today on a scale of billions of dollars through global commodity contracts, stock options, and derivative markets. The whispers that spread through Amsterdam cafes then are processed in milliseconds today by high-frequency algorithms, yet the pattern has not changed. On one side, the real asset, and on the other side, layer upon layer of papers written on top of it. From this, we can draw three clear lessons. First lesson, financial bubbles are often told as stories of foolish crowds. Yet behind these bubbles almost always lies a well-organized financial architecture. The VOC may not have been the direct cause of the tulip crisis, but it created the institutional infrastructure and mindset that made such speculation possible. Second lesson, to understand the price of an asset, it is not enough to look only at the asset itself. The value of the tulip bulb was inflated not in real gardens, but in contracts on paper. Today, gold, oil, tech stocks, even cryptocurrencies can swing wildly, not because of their real-world use, but because of the financial products written on top of them. Third lesson, the memory of economic power is weak, but the behavioral patterns of the system are surprisingly consistent. The panic that occurred over tulip bulbs in the 17th century reappears again and again in the 21st century through mortgage papers, tech stocks, or new digital assets. The vehicle changes. The psychology remains. This time is different. Now let's ask ourselves a more unsettling question. Which tulip bulbs are we looking at today? Which ones are we holding for their real value? And which ones are we holding only because we think we can sell them to someone else for a higher price? Which assets in your portfolio are based on real cash flow and which are built entirely on expectations, stories, or trends? And more importantly, where is the VOC-like power in this story? We're not just talking about 17th century colonial companies of the Netherlands. Today, the forces shaping global finance multinational giants, investment banks, funds, and data monopolies. Where do they stand in the flow of information, price formation, and risk distribution? While you see the price chart, at what table, with what speed, and with what advantage are they trading? If what I've told you has planted even a small doubt when you look at today's markets, then it has already achieved its purpose. Because the real reason to look at financial history is not to romanticize the past, but to see today's risks more clearly. So let's end the video with our usual closing. If what I've shared today helped you see the world from a different perspective, don't forget to subscribe. Because history always has an answer, you just need to look from the right angle. And I'm here to help you find those answers buried in the dusty pages of financial history.